All right, everyone, we're going to keep it moving so we don't have to keep anybody from lunch. This one is one that obviously is near and dear to my heart as a CAC specialty guy. This is titled Insurance and Litigation Finance in Action, a Case Study Exploration. And the moderator of the panel is a good friend of mine and colleague, Andrew Mutter, who is the co-leader of CAC Specialty's Contingent and Litigation Risk Team. Andrew specializes in negotiating, placing, and advocating for coverage for litigation and contingent risk insurance for corporate claimants, defendants, law firms, and finance groups. He's also got some lame lawyer jokes if you want to ask him about it, and is otherwise an all-around cool dude. So without further ado.
Thank you, Shai. Just real quick, full disclosure, the title of this, well, it's been modified. It was case studies. After doing some prep sessions, we realized we really only have time for one case study. Let's just start off with introductions, if we can go down the line. Michael?
Sure. Hey, good afternoon, everyone. For those I don't know, my name is Michael Gulliford. I manage a fund called Soren IP Capital Management. As you can tell from the name, we only invest in IP opportunities. Unlike some of our friends here, we tend to stay away from the more binary, sort of non-recourse IP deals in favor of more, what I say, credit-minded deals, more downside-protected deals that price maybe a little cheaper than litigation finance, but are, I think, more structured and so forth, and are pretty active as well, lending against IP and involved in really any kind of exotic IP transaction out there.
I'm Ayana Lewis-Gross. I am VP and underwriting counsel for litigation at Concord Specialty Risk. I've been doing this for about 13, 14 months now, and before that, I was a litigator at an international law firm for 19 years.
Hi, everybody. I'm Jim Batson. I'm the Managing Director and Co-Chief Investment Officer here in the U.S. for the commercial litigation funding company Omni Bridgeway. We're a global commercial litigation funding company. Really from beginning to end, we have both pre-litigation funding as well as all the way up to enforcement funding, so full service.
Richard?
Hello, everyone. I'm Richard Schertzer. I'm a partner at Quinn Emanuel and have been for the last 30 years. I'm also the person with primary responsibility at Quinn Emanuel for most financial aspects of our operations, which includes litigation funding.
Thank you. So we've got a great panel today, really taking perspectives from every part of what would be an insured litigation finance deal. We've got underwriter, we've got finance provider, lit funder, lawyer, and so forth. And so what we thought we'd do is walk through an actual example that's sort of inspired by a true story. A lot of sort of various details have been modified, so that don't try to figure out exactly which one this is. Give you a look, sort of deep dive as to sort of how the sausage is made on these and the various sort of pro and con considerations that go on in structuring a insurance backed monetization deal. Before we do that, I thought we'd start off with just sort of high-level overview of contingent risk insurance and what it is exactly, and then sort of drill down from there to a very specific example. So I think we have a slide, if we can go to it. All right. Okay, so contingent risk insurance at a very high level is essentially taking certainty, creating certainty out of a contingent legal asset or a contingent legal liability. And in a nutshell, you've got a liability that is not yet developed and not yet concretized. You've been named in a lawsuit, et cetera, or you have a potential claim against you. And there's a wide range of how big that liability should be, right? Other sides claiming it's hundreds of millions of dollars. You think, based on your own legal counsel and analysis, it's much smaller than that. That's an opportunity to use insurance to create certainty out of that uncertain exposure and cap your exposure through insurance in the right context when the case is high quality enough. On the asset side, what you're doing is you're taking some kind of core value that can be underwritten and understood and say, this claim is at least, at the end of day, final adjudication worth X amount of dollars. So you're taking that contingent asset that won't be final until actual final adjudication, and you're creating certainty around it. That is the core of what contingent risk insurance does. How it's used is multipled and varied, right? It's a bespoke product that can be used in multiple contexts. Real quickly, I'm not going to spend a lot of time on this, but you have a class of insurance that's sort of single matter risks, where it's specifically with one case. And the one that we're going to talk about today is when you're insuring a legal asset, legal asset preservation. It can be a judgment, it can be an award, international arbitration, and you're insuring that core value. Talk briefly on stop loss policies, protecting and capping your exposure. Successor liability and fraudulent transfers. In certain situations where you have an M&A deal, you can cap that exposure as well. It's slightly different than an actual active and live case that's against you. And then portfolios, which a number of things have been talked about today at different panels. The opportunity to take a pool of legal assets or even prospective legal assets, wrap them, and set a core minimum value to that, normally over a specific time period. So by 4 or 5 years, this pool of legal assets is going to create a certain amount of cash. Or legal campaign wrappers, where you've got a specific legal campaign. It's sort of a flavor of a portfolio, where you've got multiple defendants and maybe sort of core causes of action. That's an opportunity to create a wrapper as well. So we'll go to the next slide real quick and talk about the reasons for it. We're going to get into the whys more with this panel, but the whys are varied, right? Classic example is monetization. That asset's contingent. It's going to be several years before it actually comes to fruition. This is an opportunity through insurance and through debt financing to bring those proceeds forward now. And there's a time value to that, strategic time value to that. Lower your cost of capital. If you're a funder, decreasing your concentration risk in certain areas, maybe it's a big ticket investment, principally protecting your investment. Accelerated distributions to LPs, and, enhancing IRR and so forth. Credit enhancement if you're on the defense side, so you can actually complete a transaction, and releasing trapped capital if it's in escrow or in sometimes in trust. These are opportunities to use contingent risk insurance. We're going to take a very specific example today of judgment preservation plus monetization. So if we can go to the next slide. All right, so in this scenario, we've got a mid-sized company that after 4 years of expensive litigation that's lasted longer than expected, I'm sure many people in this room can sympathize with that. They finally received a $300 million judgment against a competitor for literal patent infringement on the basis of 4 different patents in the smartphone hardware field. The competitor had initially worked with the smaller company to consider working together, but then the deal fell through. And then lo and behold, a year later, competing product infringing on the technologies came out. There's a core damages of $200 million in actual damages and a 1.5x multiplier after the jury found willfulness. So we'll talk about this various stakeholders in this hypothetical deal. One, you've got the law firm who took the case on partial contingency, but they also had a reduced fee and were covering costs. Their current, if you count the sort of discounted billables that still haven't been paid, plus the cost that they've advanced, they're currently have $10 million outstanding. Legal Finance Group has provided $15 million of capital to date. And again, things have taken longer than expected, and now they've got a great judgment, but multiple years potentially before seeing that money come in. And the litigant, as you can imagine, has gone through a very long process, longer than anybody else in any other stakeholder, They've been harmed from this competitor from a long time ago, finally have vindication, but again, they have a company to operate, and they could use that certain cash now for various strategic reasons. In this scenario, the broker's taken a look at it and given a base projected solution where we're going to preserve a core value through an insurance policy and then secure non-recourse debt financing. The conservative expected deal, and I've deliberately made this conservative, all cases are different, is roughly $118 million financing on a $200 million policy. Could be that we can insure more, it just depends on the nature of the underlying case. With a 10 to 12% rate on line, a roughly 11% annual coupon, and then if you do all of the math with fees and expenses and premium cost, that looks like a roughly $95 million in immediate net liquidity to be potentially divided up amongst the stakeholders. So let's move on to our illustrious panel. Starting just with thinking about why this deal would be attractive, the pros of it, and so forth. I'd like to just go down the line and get everybody's initial read. We'll start with Richard. Richard, is he still beamed in somewhere?
I think so.
Yeah, and get your view, and then Ayanna, I'd like to end with you to ask you some specific underwriting questions. Richard?
So in the interest of full disclosure, we haven't done all that much of this sort of thing. We would view this as primarily a client issue. If the opportunity arose, we would look at it from the standpoint of, is this sufficiently beneficial for the client, as opposed to evaluating whether we should take an early payment on an expected contingency fee. We just don't tend to make decisions designed to smooth out distributions or bring in money early. I'm not saying there aren't exceptions to that, but that would be our take. And in that way, it's not dissimilar from a client deciding to go to a funder and monetize their claim even before there is a judgment. We would help them evaluate the wisdom of the particular transaction, give them some advice on the economics. And if it was necessary to get the deal done, we certainly would talk to them about modifying our arrangement with them, particularly if modifying the arrangement was going to put some money in our pockets. But that would not be the driver for a transaction like this.
Would you expect, if there was insurance placed, to benefit from it, or how would you contemplate that aspect of the transaction?
There's no one answer to that question. So, if the client wants to pay entirely for the premium, and we would expect that they would get the entire benefit of the policy. If we make an accommodation to help them pay for the premium, then obviously we'd want to participate. But generally, we'd be agnostic.
Makes sense. Michael?
I would say, as someone in the IP world, and as someone, by the way, who sits on the board of a company who's done a significant deal in the insurance world as well, these things, as long as these kinds of policies, as long as they exist in IP land, and I guess we can talk about whether they'll continue to exist in IP land, are very interesting. For the company, their old choices used to be they could monetize the judgment. It was much more expensive to do that than it is now when you have an insurance policy that is just a much different cost of capital. For an investor who's always trying to figure out how can I kind of remove the hair and ugliness of patent situations, and there's a lot, one of them being the Federal Circuit, right, and the uncertainty that could happen there. The idea now to underwrite sort of A-rated paper, to lend against an insurance policy in addition to the litigation, it's just an entirely different risk profile. So, cheaper cost of capital for the company, more downside protection, and we can talk about this too. I think these policies are going to be used to also solve duration risk, which is another headache we have in the patent world, right? How do we know this thing isn't going to go 5, 6, 7 years? So to the extent these are helping there, they're really helping everyone. So I just hope they continue and the industry matures.
Absolutely. Jim?
I can't say enough, positive things about the introduction of insurance into the litigation finance space. And, I've been in this space for 10 years, and the acceleration of insurance in the past year and a half has really been striking. I remember 5 years ago, we did our first, we did our first insurance deal where we were looking at monetizing a judgment that was up on appeal. And we wanted to provide working capital to the client, but the return that they were willing to accept was too tight for us. And then we found out, well, we could insure up to 80% of our investment. So there, it made the at-risk, it changed the risk profile and made the investment work. And for the longest while, that was really the only opportunity you had, which was if you had a judgment that maybe had post-trial motions or an appeal. So all of a sudden now, where we're doing deals where we can insure our full investment, depending on where the case is, we can be insuring part of the profit on the investment because the case has been successful through certain stages. The benefits to the client are enormous. Now they can realize money now and still participate in a recognized revenue stream further down the road. So helps us reduce our risk profile, gives the client access both to capital now, and maybe we even fund the premium, as well as capital down the road, and enables us to come up with all kinds of creative structures too. I mean, the word portfolio and insurance portfolio has been discussed a lot here, and there's so many different types of portfolios. So even in this one example, this could sort of form the foundation of a portfolio of 3 other cases that are insured that can then, we talk about secondary market transactions can come off of that. So obviously I could go on and on about the pros. And I'm not a paid CAC rep to be here, but it really has helped the space a lot.
Yeah, you mentioned secondary market transactions. How do you feel like insurance can play a role in that process?
Well, so a lot of the buyers in the secondary market are not folks like a lot of us here in the litigation finance space and already are A, comfortable with that risk, and B, have a sense of how to evaluate it. But they know that this is an asset class. These potential investors, they understand that it has a non-correlated aspect to it, and duration, as Michael was referencing, can be cabined sometimes. So you can now go to them and say, hey, here's this type of investment with this type of return structure, but I know you're not that familiar with it, and even more so, I know you don't feel that you're in a position to dive down into the underlying assets themselves, the litigations. We'll do that. We've done that. That's our expertise. We are experts in evaluating litigation, and your downside is protected. So I mean, it's a lot like some of these retirement products where you can't lose your principal kind of thing, and so people are more comfortable investing in them. It's the same concept. So I think it's great, and it basically, after a long-winded answer, it opens up a much broader group of investors that would have been afraid to consider this.
Yeah, I agree. I couldn't agree more. I mean, I think a big part of what insurance is doing, in my view, as a broker in this space, is exactly playing that role as sort of a third-party evaluator of legal risk that, beyond just the risk transfer element, I think is a helpful sort of communication and signal to third-party investors that don't have Omni's expertise and diligence to understand a legal asset, right? You use, leverage underwriter like Concord, where you've got, excellent lawyers who are able to dig in and actually come to a very high conviction around that. And not only that, not just provide an opinion that they think the risk is good, but in fact, back that with A-rated capital. That's a game. You're opening up this asset class to a different kind of investor, I think, through that, through sort of outsourcing that expertise. And so that leads me into my questions for you, Ayanna. So you are that esteemed professional, right? You've got an extensive background litigating for a long time in commercial cases. Perfect. You're part of one of the lead foundational underwriters in this space at Concord, and Dave DeBerry. You're applying that skill set to these cases on a day-to-day basis. Let's turn to our example here, right? You've just received another top-notch, excellent submission from CAC Specialty on this risk. What's your first right off the bat, what are you looking for in this case, and what are your key considerations?
So I will say, then we get a submission from CAC and from other top-notch brokers. We know that everything we need is going to be in that submission, so that's a thing we always appreciate. And so what am I looking for? I am looking for, so here, there's already been a trial verdict. What was that verdict based on? We will go and read the patent ourselves to see what we think of the actual decision. Was the patent properly analyzed? Was it all of the pieces that need to be done? But we also want to form our own view, separate and apart from what has happened before, to make sure, does it strike us as being the right decision? Because what we've learned is sometimes just because the decision checks all the boxes, but it feels hinky, means something is going to go wrong. So there's a little bit of a gut check involved in all of this, but there's also a lot of very traditional legal analysis. We're looking, was there a Markman hearing? Was there an IPR? Have all the potential landmines been overcome? There is always a risk with the Federal Circuit. I mean, when I first started, I read an article that called the Federal Circuit schizophrenic. And so because of that, I will say your 10 to 12% rate online might not be right. That might be a little too low.
That's right.
But what we are doing is we are doing our own independent legal analysis. We're doing a gut check. We are discussing it, amongst ourselves, talking to counsel for the party, if they're the insured, if they're available to us. We always like to hear what their experience was at trial. We like honest analyses from counsel, so telling us where are the risks, what are the things that concern them. We don't want to be surprised by anything. We'll probably figure it out ourselves, so it's better for counsel to raise it with us from the outset so that we have trust and faith in them and what they're telling us.
Yeah, and that's certainly a big part of our process. We want to put those issues in front of you first because it's better, especially for deal certainty. If those issues do come up eventually, you could have spent a lot of time and a lot of resources and money only to hit the rocks on something that really should have been talked about from the very beginning. Agree. Talk to us a little bit about patents in general, patent judgments in general. Because of the uncertainty with the Fed Circuit, because of the kind of developments in the IPR process, how do you think, you mentioned you sort of have these gatekeeping issues with Markman hearing, IPRs. Unpack that for us a little bit.
I mean, we have, to the extent we have hard and fast rules, and I will say that all of our hard and fast rules, are always a little flexible on the edges. But we will not insure a case that hasn't been through a Markman or IPR, generally. I will tell you I'm looking at something right now that's in an earlier stage. It's a wider range of cases, so there's a little more protection because it's more varied. But we will take something that's been through, post-summary judgment, where we have some legal analysis, where we have a way of analyzing what the court is thinking about, what the issues are.
Yeah.
We have a strong preference for post-Markman, post-IPR. Let's put it that way.
Understandable.
Can I ask one quick question? I'm just curious, have you seen any deals with where the insurers have started taking some upside, right? Like, to the extent you're getting in earlier, you're essentially acting like a litigation funder, right? And so, I mean, I'm not an insurer, but I would think that's more risk. And so I'd at least want to be rewarded more on the good side, the upside of that. And I'm just curious, I haven't seen those, but I'm wondering, is that kind of coming in this market?
I mean, I received a submission this week that offered some of the upside. I mean, I got it this week. We haven't figured out what we're doing, but yes, I have started to see more of that as a proposed solution.
Yeah.
I just thought I'd highlight for the group something, Ayanna, you were saying. You can get insurance now pre-trial. I mean, that was inconceivable, a couple of years ago, and changes the whole way you can look at pricing.
Yeah. Speaking of,
and in that vein, I have started to notice that some of the funders we deal with are basically making their term sheets contingent on getting insurance, even pre-trial. Sometimes they're explicit about it. Sometimes I know they're doing it, but it's definitely something that's happening in the marketplace.
yeah, absolutely. And in many ways, we could come back to that when we talk about sort of the considerations, cons, things to think about, complicating factors with insurance, but contemplating the insurance early in the LFA, that's something that we've seen as important and helps avoid friction in a deal in the future. Absolutely. So, Ayanna, looking at sort of this hypothetical and its attachment point, 200 out of 300 million, you've got this willfulness 1.5x multiplier. You've got multiple patents. We don't know yet. We could hypothetical, look at what does each patent represent in terms of the damages, which is all stuff that we work through with you in depth. Talk to me about attachment point and pricing. You talked about pricing as well. How do you see the trend right now? How do you approach attachment point?
So for pricing, cost of capital is getting more expensive for everybody, right? Across all sectors and all industries. Like, we think that rates are going up. We don't want to obviously price this product out of being useful to people, but I think when I started 13 months ago, rates were probably 8 to 12%, and I think they're very easily 10 to 15 now, and higher. I've seen significantly higher than 15%, particularly if there is a deferred and contingent premium on the, for the upside. Sorry about that, Mike. So pricing is going up, as I said. For setting, what portion is insurable, it's completely dependent on how the judgment is set up, right? We don't like to insure punitives because punitives are an easy way for an appellate court to cut back the judgment if the number shocks their conscience in any way. We have done it, but we don't. So here, if the 200 is the reasonable royalty or the lost profits, that is, for us, would be a good number to set the insurance at and leave the retention of the 100 million if that's the willfulness piece of it.
Yeah. No, we get the question all the time. Well, I've got this judgment. How much of it is insurable? Is insurable? Well, it depends, right? It's the classic lawyer answer, right? It depends. We're going to have to do a deep dive. There's going to be breaks in the damages, and it also is it's a trade on how much premium you're willing to spend. That above 200 million in this example could be insurable, right? But are you, your client, whoever's the stakeholders providing the premium and we're ultimately agreeing on this deal, is 16% for that extra tranche worthwhile? Is 18%, right? You can start to get really up there as long as the markets feel like it's a good trade. But it's all a matter of analyzing the legal issues and finding out the damages breakpoints and the legal issue breakpoints that, come to a high conviction about.
Yeah, and I also want to say, particularly for litigation funders, we at Concord are willing to insure the full amount of an investment if that investment has already been made, because the decisions were made independent of the insurance. We are not encouraging the litigation. Not all of our backing carriers agree with that approach. Mm-hmm. So it depends what your investment is and how much of our capacity we need to access on whether or not we're going to be able to insure the full amount of the investment. We also will, if there's already a judgment in place from which the funder is expected to get a 10x return or whatever it is on their investment, insure some part of that return.
Mm-hmm. Absolutely. So let's turn now sort of thinking about our quote-unquote con list. Thinking about bringing insurance into a deal, trying to do one of these deals, what are the sort of, in your experience, considerations, complications, things that people need to know and be aware about before embarking on that kind of process? Michael?
I mean, I think two things. One is, first of all, we didn't talk about this, but worth noting, as these policies can get expensive, not atypical to see a policy that costs 50, 60, 70 million. That can be financed too, right? I mean, that's an interesting financing opportunity. But in terms of cons, I think, well, as an investor, they really drive down the price, just the returns of your deals. So if you're looking at a 15% premium and you're talking to your LPs about a 20% net IRR or 25%, I mean, litigation finance, right? We see all the time 25% IRR. If you're funding an insurance policy as part of that funding, that's a very difficult return profile to meet. And then, at least for me personally, I've seen a bunch of policies with terrible exclusions, right? I mean, they really don't come in one standard shape and form. At least in the IP world, I've seen some that just run out after a certain period of time. And that's just a huge, I mean, that's a huge risk. That's one of the main risks in IP.
None of those were brokered by CAC.
They were not. They
of
were
course.
not, bro. I can
No.
guarantee you they were not.
Yeah, but that's a good point. Jim?
So for me, the only real cons have to do with process.
Yeah.
And so, some of the frustrations I've experienced from time to time are some of the same complaints people raise about litigation finance, right? The lawyers and the clients who we're already dealing with ourselves in our underwriting process, right? I'm kicking the tires on the case, so I'm talking to counsel, I'm talking to the client. They don't want to have to go through that a second time with the insurer. And when we first started using insurance in some of our investments, it had to be sequential. So we would do our diligence, maybe we would get an external diligence opinion, and then that opinion would have to be shared with the insurer, at least in part, and then they would then underwrite that, and it took a lot more time, and there was more interaction between the insurer and the client, so that it was just a little bit more disruptive. And to Richard's point, sometimes if the deal is contingent on getting insurance, the client would be like, well, why should I bother with you guys? I need to get it approved twice. I'd rather go with somebody else. I think those issues have been solved substantially, particularly when you have brokers that are lawyers and can understand the case quickly, so that basically they can package it the way a litigation finance broker sometimes packages things and present it to the insurer. The other critical thing that's important for us is, at Omni Bridgeway, one of the things that's critical to us is being able to convey to the client and or counsel pricing early on. Saying like, this is the deal, so that we both know if we're going to spend a lot of time and effort together, this is where we're going to work it out. Well, if I know that it's something that we would need to be insured, or that the client wants to insure part of the recovery as well, not just our investment or return, then I'll go to Andrew, David, and Megan and their team, Shay, didn't mean to leave you out, to get an indication of what the market looks like.
No.
And it's critical to us that that indication is accurate. And when it is, then we can build that into our pricing. We're not too worried about, would we have to make an adjustment later? We might even commit to not making that adjustment because we can rely on that. So certainty in pricing, certainty in process, and not having disruption or minimizing disruption with the client and the lawyer are sort of the big things that are always a challenge and that we're always trying to minimize.
Richard, do you have thoughts on, kind of cons or considerations coming from your perspective?
I do. So consistent with what I said before, most of the downsides, and there aren't substantial downsides, are for the client, not for us. And probably the one I've observed the most is just the amount of time it takes to put together a broker's presentation and to actually secure some form of judgment insurance. At least in my personal experience, that is taking longer than it would typically take, for example, to negotiate a funding agreement. And sometimes the client needs a quicker answer. And maybe a quicker answer is sometimes available, but hasn't been in my cases. From the standpoint of the firm, no real downsides, because by and large, this is an arrangement being made by the client for the client's benefit. Now, as I said before, if the client comes back to us and seeks some sort of accommodation in our arrangement to help facilitate their insurance, that's something we have to look long and hard at. In a general matter, we're not inclined to change our contingency arrangements. But of course, we also want to help out the client, particularly in exchange for participation in a way that would de-risk us.
No, absolutely. Well, I don't know if this is working because I'm not seeing any questions, but maybe it's just we don't have questions. If anybody has questions, we can do a little Q&A real quick. Otherwise, I do have a final question for the panel. Okay. So just
I think
going.
there was one question.
Sorry, go ahead.
All right, way over here.
Yeah.
So at what stage, if you are trying to insure an international litigation portfolio, where oftentimes you obtain injunctive or preliminary injunctive relief abroad before you reach a judgment in the United States, do you ever insure those types of judgments, or do you have to wait until you have a more secure judgment in the U.S. or some flavor of what your U.S. judgment is going to be like.
Give me the answer.
Yeah,
I mean,
yeah.
For Concord, you have to wait until you're in the U.S. We will only insure U.S. litigation and U.S. judgments. Andrew could talk about other players in the market who do different things.
Yeah, I guess I didn't quite understand the hypothetical, like the setup. Are you talking about you do have a judgment of some kind, but it's just not? Sorry, explain it one more time.
So lots of times in an international patent campaign,
Right.
you will have parallel litigation. You'll have a United States litigation, and then one of the advantages in pursuing relief in other jurisdictions is A, you can get an injunction, and B, you can get it more quickly than you can get a judgment in the
Germany.
United States, for example.
Yeah.
And so the question is, if you're at that stage where you've obtained injunctive relief elsewhere, is that an insurable interest? There's also a U.S. component. It's usually, speeding along, but still slower than the international components.
I would say, this is the classic lawyer answer, we do this all the time, is it depends, right? And so in that situation, if you've got a relatively high conviction of what those damages are, right? And the nice thing about like an injunction, for instance, in Germany is they're precluded, if they have lots of sales in the EU, right? Then that can be a really particularly a huge cudgel, obviously, to get the defendant to settle at a reasonable amount. It's all about confidence intervals for insurance. It's not something that works for every single case. If we can, based on the case, damages analysis, and so forth, look and say, yeah, you're either going to get a settlement core value of at least this amount, or there's going to be, a judgment in the U.S. that's going to award this core amount. It may not be everything that you're expecting to eventually get. There might be some discounting there. But if we can get to a high confidence interval around some core value, that's when it's potentially insurable, even in that stage. We'd have to do it with markets that have the ability to write European risk. We do that all the time.
Yeah, I mean, with a little clarity, I think, based on your description, if there is pending U.S. litigation, if the litigation has been filed, then that's an insurable risk by Concord. And the fact that there's an injunction in Germany is something we would consider. But if there was, you had an injunction in Germany and there hadn't been any U.S. litigation, that probably is not right for us. But as Andrew said, they'd have to find the right markets.
Yeah.
And there's another solution that we've actually seen that involves insurance. So we might be able to finance the undertaking at a certain rate as if there were no insurance initially, with the understanding that the goal is to obtain insurance, and that if the insurance is obtained on part of it or all of it, then the funding pricing drops. Maybe the part that was at risk is at one level, the part that's coming in now is at a different level. So you can sort of have a staged funding arrangement where we are immediately either seeking litigation at the outset, or maybe we're waiting until maybe the U.S. litigation has started, or the U.S. litigation has passed the motion to dismiss or passed the summary judgment motion, and then we could obtain insurance. So,
Thank you.
I bet.
All right, question in the back.
Good afternoon. George Matamoros, partner with White & Case International Arbitration and Litigation. I have a question, I guess, for everyone on the panel. I think that the goal of the panel is kind of give us an overview of the deal flow and the role of the various participants and stakeholders. And so it's a question focused on process. In your estimation and an experience, how many sets of eyes in terms of actual lawyer legal analysis conduct due diligence? Because each of the organizations represented in this example, of course, has different risk profiles and different stages, different risk appetites, and so on and so forth. And kind of based on that, how does that cost of successive moments of due diligence or in parallel, but various looks, duplication, triplication, how does that cost kind of get allocated throughout the deal flow, and how much does it impact, in your estimation or your experience, the actual deal eventually?
Yeah. I'll say for our part, when CAC takes a matter, and that work is free to our client, right? So we have a team of corporate litigators that will do a deep dive in the case and do our own sort of preliminary analysis and diligence. And all of our work ultimately is free to the client. We get paid through commission. The next stage in an insured deal would be to present it to the insurance markets. They do a lot of, Ayanna's a lawyer, she does her own view and diligence, but then there will be an underwriting fee once you pick your primary that in part goes to outside counsel doing a formal report, right? And that's another set of legal eyes and its own sort of cost. That's the first time normally in our process the client has a specific cost. I don't know if anybody else want to chime in.
And then on the last stage, I think of that example would be the litigation finance company, and as is the case, as Andrew pointed out for CAC, we don't charge the client or the lawyers for the due diligence if the deal doesn't get done. If the deal gets done, it might be part of the return at the end of the day. So you actually highlight a really interesting point about using litigation finance folks and insurers in combination, because so many different sets of eyes have looked at it, and it should give you and or your client the added level of confidence that, okay, it's not just me who's come to really believe in this case, it's not just the litigation finance company who has one perspective, but all of these people have looked at it, and for the most part, we'll all share our views of the matter with you. You know, it might be oral, it might not share our documents, but we'll tell you what our concerns were and what got us comfortable.
And sometimes that makes the case better. But I see we're out of time. Thank you very much, and thank you, panelists, and Richard, for doing this with us. Thank you.
Thank you.